This is our kickoff event for 2023, and we're going to use a PowerPoint presentation, which we hope you find insightful and actually entertaining. And in the spirit of making this fun, I did want to share a story. It was from the Des Moines Register in the wanted ads, and it says, "Help, my brother has 2 tickets to the upcoming Super Bowl. He was so excited. He paid the $3,500 for each ticket as soon as they went on sale. However, he didn't realize the game was going to be on the day of his wedding. If you are interested, he is looking for someone to take his place. It will be at St. Francis Church in Des Moines, Iowa at 3:45 p.m. She's a great cook and will be in the white dress."
Richard, that reminds me of, I was talking to a friend of mine and he told me his wife left him. She said that his life revolved around football. He was pretty upset. He told me that they were together for 7 seasons.
And so one reason we like this football theme was because it kind of combines this year California and Iowa, where I'm from, because the San Francisco's quarterback is Brock Purdy, who was at Iowa State University for 4 years until this year. He was the last person selected in the draft, called Mr. Irrelevant. He's the lowest paid professional football player, and he may have had the best rookie quarterback season ever. There's so few good things like that come out of Iowa. When we get one, we really embrace it no matter what. So anyway, here we go. Can the financial bulls make a comeback this year? We don't think so. We don't think so because last year we had some big changes in the economy. The war in Europe is an ongoing, obviously difficult situation. There was aggressive interest rate increases, inflation pressures, and all this was happening in the context of a deteriorating global and domestic economy. Jeff found this chart for us from PIMCO. Jeff, what's this chart about and what's it tell us?
It really tells the story of last year, the 2 most important drivers. The first, over on the left with the green line, is inflation measurement. And you can see that in late 2020, inflation bottomed out and has gone up since then. The war in Europe was really the kerosene thrown on the fire that made that line go straight up. And on the right, this is PIMCO's financial condition index. You see down there at the bottom, the green where it says more accommodative, that we called zero rate interest policy. Very low interest rates, very accommodative to the markets. Well, they started raising interest rates in March of 2022. And as you can see, they've gone straight up. They have raised it every month through December so far. So that's very unaccommodative to the markets and economy.
The only reason asset prices, stocks, real estate, etc., had gone up so much was this going down to zero in interest rates. Jeff, this next chart you made, what is this all about?
Well, this tells the story of the bond market in 2022. And just as a reference, we always talk about the stock market and the bond market. And a lot of people don't know, actually, the bond market is actually much bigger than the stock market. What happened last year, you can see by this chart, it goes by duration of bonds. In other words, how long the bonds are. The brown is the short-term bonds. The green is your intermediate, like 7 to 10 years. And the blue is your long bonds, 20 plus years. What you can see there is real simple. The prices of bonds went down a lot due to those twin shocks of inflation and fast rising interest rates. I think there's 2 things I draw from this. And in talking to PIMCO, the largest bond producer and manager in the world, is that when bond prices go down, the yields, the coupon, the dividends they pay goes up. And so what's happened is the yields have been climbing the amount of dividends you can get off of certain bonds. With these prices down, I think there's a lot of buying opportunity in the bond market. It's like everything. There's a lot of negative that can be seen in this, but there's also some outcomes that I think will be good for bond investors.
Whoa, what do we have here?
Jeff Gunlock, who's considered the current bond king, manages tens of billions of dollars of bonds in his company. But here's what he says, and it's very prescient. There is no way the Fed is going to 5%. What he means there is right now, the Fed fund rate is at about 4%, and the target for the Fed is 5 or 5.25. He doesn't believe that the Fed's going to be able to get there. And he says this: the Fed is not in control. The bond market's in control. He's saying that the pricing the bond market's doing right now is going to dictate what the Fed can and can't do as we go forward, probably from right about now.
The Fed and the bond market have very different views right now. The Fed keeps saying, oh, we're going to go 5% or a little more than 5. The bond market believes that the economy will be contracting sufficient so the Fed will have to start lowering rates before they get to 5 or much above. Personally, I think it could get to 5.5, but then it likely would be coming right back down. Yeah. Now we're going to move on. That was my favorite slide.
Oh, Richard, you look at global risk every year, early in the year, and the opportunities. I know you have some analysis about circumstances in China and Europe that should be relevant to investors really everywhere. Can you lay out some of the concerns that we need to know?
Yes. In China, the biggest concern is real estate. Makes sense because 80% of Chinese citizens have 80% of their net worth is in real estate. That's where all their growth has come from. And Martin Wolf is a pretty smart guy from the Financial Times. He said, since the government controls the Chinese financial system, it can prevent a financial crisis. He says the likeliest threat is that investment in real estate will collapse, and just a 20% fall in real estate buying could lead to a 5 to 10% fall in GDP, which it is doing. That's rather noteworthy because 5 to 10% negative economic growth is more like a depression than a recession. I mean, that is serious. He says at the end there, it could be worse. Notice he says the government controls the Chinese financial system, and so they may be able to prevent a financial crisis. The Fed does not control our financial system or our markets. 3/4 of all their influence is called psychological, convincing investors it's going to be this way or that. And the remaining amount of Fed influence is raising interest rates, which they've been doing. The other thing I wanted to mention briefly about Europe, I was looking on TV this morning and they were kind of excited because European bank stocks have been going up this year, quite a bit. Yeah, they've gone up last few weeks. They are now where they were in 1987. That's a long time for a major stock sector to not move. So Europe, I don't know if they'll get through this without the financial crisis. I don't know if China will, and I don't know if we will. But again, that's not the point. The point for us is, where are the losses going to be? How big are they likely to be? And where are the opportunities that will be happening at the same time?
This is a chart of what happened in the markets in 2022. What is your take on all that?
So the green line is the Dow, and the Dow only went down 8.78% last year. Not bad. The strange thing is the Dow didn't get killed in the year 2000 either. the last biggest stock market downturn. 2008 and 9 was comparable in reality, but 2000 was quite a crash. And the Dow did real well the first year of that. Well, the blue line is the broader market, the S&P 500 down 19. And then the brown one is NASDAQ, the tech stocks down 33. So most people who had stocks lost in the neighborhood of 19%, 20% last year. The unfortunate thing was the most common portfolio of 60% stocks, 40% bonds went down 17% last year because the bond market went down, of course, along with the stock market. This is a chart showing the valuation of the stock market from 1928 to the end of last year. So very long time period. So we see that in 1929, stocks had become a little expensive. In the year 2000, led by the dot-com big tech stocks, they were a little overpriced. And look at where we were at the end of 2021. Here's where we ended last year, a couple weeks ago. Now we're up a little bit since then, by the way. So last year, the stock losses were so big, we are now tied at the most overvalued market ever, tied with 2000 and 1929. The first question we asked in this presentation was, are the bulls gonna win this game this year? In other words, will the stock market turn around and go straight up again? Well, this chart certainly doesn't show us what's going to happen next quarter. It's not it's a very long chart, but you just look at it. Unless a huge number of real good things have changed lately, it certainly looks like falling is on the table for us.